Hello, everyone. Welcome back to the second day of the conference. I think we had a great program yesterday. I saw many of you participated. We also have a great academic program. Just want to briefly say that we had almost 100 submissions, of which we had to select only 8 papers. These were all excellent papers, so very much looking forward to hear your presentations and discussions. I'm going to turn over to Paolo. He's going to moderate or chair the first 2 papers, and I'm going to come back for the second 2 papers of today.
Yes.
So, to you, Paolo.
Yes, so let me first start by laying down the rules that we have. So the presentation will have 20 minutes, the discussion 15 minutes, and 5 minutes, only 5 minutes for questions. We have decided to try to give the possibility to people to speak out. So raise your hand. There is a feature that you have by which you can raise your hand, and then I will give you the word in order to speak. This is going to happen only at the end of the discussion. However, you can always ask questions on the Q&A feature of Zoom, and this and I encourage the co-authors. There is someone who's not muted. I encourage the co-authors.
I think we're good.
Yeah, okay. And I will encourage the co-authors to reply to the questions as the presentation goes. So you can ask a question during the presentation by typing into the Q&A, and otherwise, speak out when you're given the word at the end. And please signal to me you would like to ask a question by raising your hand. And for presenters and discussants, I'm gonna please keep an eye on the side, because I'm gonna give you like the number of minutes that are left, 10, 5, and 1 as you speak. So unless I forgot anything, let us start it. Oh, by the way, we have the first 2 papers, and then we take a small break, 5 minutes, then another 2 papers. And then in the end, we have a mingle room or session. So you're more than welcome to stay, attendees and panelists. In that room, we all see each other and we can all talk. So please feel free to stick around. If there is a lot of interest for one specific paper, we might actually decide to create an additional breakout room, but we'll start with just a general mingling. So let me get started. So we have the first paper, Do Women Receive Worse Financial Advice? And I think Amit Kumar is going to present, and Tabea Bucher-Koenen is going to discuss afterwards. You have 20 minutes and later 15. Please go ahead, share your slides.
Sure. All right, so are the slides visible? Okay, so are the slides visible? Can anyone confirm?
Yes, yes.
Okay,
Yes,
perfect. So, all right, so hello everyone. I'm Amit from Hong Kong. So first of all, thank you to the organizers to allow us to present this paper at this platform. So good evening to our colleagues from Asia, good afternoon to our colleagues from Europe, and good morning to our colleagues from US. So this is a paper, Do Women Receive Worse Financial Advice? All right, so to start the presentation, we want to share one incident that happened with one of our colleagues. So one of our female professors in finance visited a financial advisor, and the advisor asked, do you have your husband's permission to buy this financial product? And to learn this, we were quite stunned. And this might tell us what might be happening into this industry. Nonetheless, so we begin with certain observations. First thing we find is that the seeking financial advice is quite common. Many studies have recommended that have shown that a lot of households seek financial advice. Second, women are increasingly holding more share of financial wealth. In fact, in the United States, in 2015, women held more personal wealth than men did. Very interesting. But when we look at these 2 facts together, it raises a very important question. Is are women getting the same quality of the advice as men do? So this leads us to the research question of our paper, which is that do women receive worse financial advice? So we will briefly review the literature. So the first paper we definitely want to mention is the paper by Tabea, who is also our discussant here tonight. So they have a very interesting data set of a large sample of an advisor and advisee transcripts, and they document a very interesting fact, which is that women are more likely to be given funds with high fee, and they are less likely to be receiving upfront rebates, which is indeed very interesting. There are other papers which talk about different aspects of financial advice, which are listed here. Moreover, our paper contributes to these three literatures, which is gender difference, financial literacy, and a small emerging literature, which is Audit Study or Field Experiments in Finance. Mulanathan and Shore 2012 paper is one of the first to choose the field study in finance. All right, so we want to say that we don't only want to understand that if women receive worse advice, we also want to understand why, what are the mechanisms and set of attributes that leads to these outcomes. So when we want to do that, we lead to certain issues. One of the first issues that we reach is establishing causation. So if one were to analyze the already formed meetings between an advisor and the advisees, then what is going to happen is we won't be able to say, even if we find a gender difference in the outcome, we won't be able to say whether this is because of certain attributes or is it because of the matching, because the matches are randomly formed. Second thing is, even if the matches are random, there are attributes which is not observable to the researcher, but those same attributes are observable to the financial advisor. So it becomes difficult to establish causation, what is leading to those outcomes. So what we do, as a solution, we employed a field study in which we would be breaking this matching, endogenous matching. What we are going to do is we are going to hire certain auditors, and we are going to randomly create these matches with the advisors, and that would allow us to focus, remove the effect of this matching and establish the causation from the attributes to the outcome. Second issue that we face is how do we measure financial advice? Now, one of the popular methods in finance is to measure the alpha, which is an ex post measure of the performance that has been recommended by the advisor. One problem with the study of audits, with the type of audit study that we do, is that advisors usually in the first visit, they do not recommend a weighted portfolio. Second method that usually literature uses is the fee of the funds, in which a client can go and ask for a fund which is linked to a broad equity index based product, and then we can analyze the fee of the products that the advisor recommends, and that way we can measure the differences in the gender. But what happens here is, again, there is very little variation in the fund fees that are available in the Hong Kong, so we couldn't do this either. So what did we do? So our solution was that we came up with this very minimalistic but objective measure and very general. So our method is that if an advice contains of all the products that is only individual risky securities, we are going to be calling it as undiversified advice. If in an advice, all the securities that has been recommended, if all of them are only local securities, we are going to classify them as home biased advice. Otherwise, it's not home biased, or otherwise it's not undiversified. So these two types of advice, which is undiversified or home biased advice, we call it as a dominated advice, or in a simple sense of, let's say, a bad advice, or otherwise it's an undominated advice, which in simple words is good advice. All right, so now we reach the third issue, which is extremely important in gender studies, which is the statistical versus the taste-based. Now, it's obvious that men and women differ across many attributes apart from gender. Some of the attributes are, for example, risk tolerance or confidence. So in this case, even if we find that there is a gender variation in the quality of advice, how do we know that it is not because of the attribute and it is coming from the gender? So how do we break this link between the attribute and the gender? Now, we can do that in our setting, which is because we are employing the field study in which we are randomly going to be changing the attributes for the trained customers or the potential clients that we hire, the auditors, and we will be sending them to the advisor. So what is going to happen is that if we control for these randomly varied attributes, and if we still see the gender difference, we can at least say that the gender, at least these attributes we control, and the differences still exist. We cannot control for anything. And at the same time, we cannot rule out certain taste-based discrimination. We'll be talking about it later. All right, so how did we do the audit study? So in any audit study, the first thing to start with is to identify the firms to audit. So what did we do? Is we created a list of all firms in Hong Kong which offer financial advice. And then we found out all the firms. In the long process, we found out all the firms which offer advice to retail customers. And then we visited all of them. What we ended up doing is we are going to visit 65 firms in Hong Kong, 102 branch offices, and in total 463 visits that we conducted. So another feature of Hong Kong is that we have two sets of firms here. One we call as financial planners, or in short, FP. Now, these are unique firms in the sense that they give advice, but at the same time, they are more relationship oriented, or they are similar to what we see in the US as a wealth manager, with the exception that these wealth manager kind of firms are also going to give advice to retail clients in Hong Kong. The second type of firms, we call them as a securities firm. They also give advice to retail clients, but the key difference here is they are more on the earning revenues from the trading commissions, and they tend to advertise their trading services. They compete on their price. So they are more like the full service brokerage firms in the US, but both of these types of firms give advice to the retail clients. So we are able to exploit this unique institutional incentive difference in Hong Kong in our study. So the second ingredient in the audit study is the auditors. Who are these people whom we are going to send? So we employed a marketing research firm, a popular one in Hong Kong, and we hired 16 male and 16 female auditors. We matched their demographics based on the local demographic of Hong Kong. All of them were Hong Kong residents and limited financial experience. Now, the most important part in this audit study is the auditor's attributes. So what we wanted in our study is we wanted our trained auditors to sound as natural and free-flowing as possible. So what we ensured is that when they go to the financial advisors, they are going to be truthfully reporting some of their attributes, like their age, education, net worth, etc. This is also because sometimes advisors ask for the ID and other things, so it can be identified. So we kept it to be truly reported. No, but what we did, however, in our study is we randomly varied 3 important attributes. These are the 3 attributes, which is risk tolerance, confidence, and the geographic outlook. Now, in each of these 3 attributes, there are 2 levels in our study. So an auditor can have either a high risk tolerance or a low risk tolerance. At the same time, the auditor can have either a high confidence or a low confidence, or vice versa, for either he or she can have international outlook or domestic outlook. Now, how do we signal? So we wanted the whole process to sound very natural. So we created a minimal script to signal these attributes. So when an auditor wants to signal that he has high risk tolerance, he starts by something by saying, I don't mind if I lose some money sometimes, but I want your advice to invest my money. When the auditor wants to say that he has low risk tolerance, then he or she starts saying something like, I want to buy something that is safe. And similarly, we created the script for representing high confidence or low confidence, and for creating the signal for the international and domestic outlook. So to repeat, each of our auditor will have gender as the first characteristic, and one level of all these 3 attributes. So he can have high risk, he or she can have a high risk tolerance, high confidence, or international outlook. So with this, we start in the paper with the model that links advisors' incentives to statistical discrimination in financial advice. here, I would not go through the model, but I would give you the intuition. So in this model, the advisors earn revenue from giving a dominated advice. Why this happens? Because they earn the trading commissions when the clients trade on the advice that the advisors give. Now, as we discussed, securities firm, or in short SF, earn revenue mainly from their trading services. So they have this higher incentive to give dominated advice than financial planners have. And this gives us the first implication of our paper, which is that what we expect to find is advice from securities firm is more likely to be undiversified and home biased. Now comes the second ingredient in the model, which is advisors want to maintain a relationship, continue a relationship. Now, when they want to continue the relationship with the client, they want to cater to the attributes of the clients to strengthen this relationship. But at the same time, the clients who might have better financial knowledge can detect that the advisor is not giving a good advice, but rather catering. And in that case, the client can terminate the relationship. So this creates this tension for the advisor. And since this relationship, this trade-off is stronger for the second set of firms, which are the financial planners, we reach to the second implication of our model, which is that financial planners, or FP, are more likely to be giving dominated advice to female than to males. But we are not going to be finding this attribute for the securities firm because they are not very relationship oriented. They focus on earning revenues from the trades. Now, when we continue the similar logic, we reach the third implication, which is that if a given client, irrespective of gender, shows that they have a high risk tolerance or high confidence or a domestic outlook, if the advisor wants to cater to these attributes, then advisor is going to be giving more dominated advice that matches these preferences. But at the same time, advisor have a prior that women can detect less that the advice is bad as compared to male. So they are going to be catering more to women than to men, even for the same attributes displayed by the men and the women. So that leads us to our third implication here, is that financial planners are more likely to give dominated advice to women than to male clients, even with the same attributes of high risk tolerant, high confidence, or domestic outlook. So now let's see what we found empirically in our paper. So the first result that we find is that the likelihood of receiving a dominated advice is 39%. To put it into perspective, it means that in Hong Kong, if a retail client visits a financial advisor, then 2 out of 5 are going to come back with an advice to invest in just a bunch of 6 stocks, which seems quite bad. This is exactly what finance tells us not to do. Now, second is we find that securities firms are more likely to be giving undiversified advice than financial planners are. We do not find this difference to be significant in the home biased advice. And this happens because incentive is higher for securities firm than for the financial planners. Third result, empirical result that we find confirms the second implication from the model, is it is actually the financial planners who are more relationship oriented are the one who are going to be showing the gender difference between the quality of advice. This is why. This is because they have the prior that the women are less likely to detect the dominated advice. And that's why they can get away with giving a dominated advice to women. And finally, the third implication is that among the high risk, high confidence, or the domestic outlook clients, financial planners are going to be giving dominated advice to women more than to men who displays the similar attributes. All right, so with this, we show the results. So here, what we are looking at on the left-hand side is the likelihood to give undiversified advice. We see that the green bar represents that securities firms are more likely to be giving worse advice than financial planners, and it is statistically significant. Same goes for the home bias advice, but we don't find the statistical significant difference between these two types of firms. Here we start to see the difference between one set of firms and the other, and this is exactly what we find is that for the financial planners, which is on the left-hand side in the graph, the difference is significant, and they are more likely to be giving the undiversified advice to women than to men. And same thing goes for the home biased advice. It's the financial planners who are more relationship based are going to be given differential advice between females and male and worse advice to female. Again, the intuition is that females, they think that females cannot distinguish between, cannot detect dominated advice. This brings us to the last set of our results, which is the client's attributes. So in this graph, what we are looking at the screen is on the x-axis, we have the auditor's risk tolerance. On the right-hand side are all the auditors with high risk tolerance. On the left-hand side, we have all the auditors with the low risk tolerance. What we see that among all the auditors with the high risk tolerance, it's actually the women who are going to be given, more likely to be given undiversified advice than men, and it is coming from the financial planners. The green bar here represents that it is a statistical significant difference. What it actually means is that same dialogue was said by a woman and a man to the advisor, but still the advisor is responding when it was said that I want a high risk product. Advisor is giving worse advice, more undiversified advice to women, but not to men, which is very, very interesting result. And we attribute it to the fact that advisors think that women cannot detect that worse advice, and that's why they are doing this. Now, here, the second graph here, we show the same thing for auditors' confidence, and we find the exactly same difference. Among the large confidence auditors, women with large confidence are more likely to be given worse advice or undiversified advice as compared to men. And the difference is statistically significant. And finally is the home-biased advice, and we see the same difference for auditors which showed that they have a domestic outlook. Again, women are going to be receiving more home-biased advice than men are. So this confirms with our third implication from our model that we just discussed. So finally, to conclude, we will talk about the contributions that we make in our paper. So one of the first contributions that we make here is that we are the first paper to use a natural field experiment or audit study to study and establish that there is a gender difference between male and females, and we are able to provide causal evidence on what attributes leads to these outcomes. Second contribution that we make here is that it is actually the interaction between the advisor's incentive and the prior that women might have different financial knowledge than men that leads to this outcome in a statistical discrimination world. But at the same time, as we said that we cannot rule out certain taste-based discrimination stories, the story that we cannot rule out in our paper is that if financial advisors simply discriminate against women who go against their gender stereotype, if they just don't like this category of women and they just give them a bad advice, then it is also consistent with what we find. So we cannot rule out this particular taste-based discrimination. So with this, we would like to finish our paper. Thank you for listening, and please reach out to us, to any of the co-authors here with any comments, questions, and suggestions. So I look forward to the discussion by Tabea. Thank you.
Thank you so much. Perfect timing. So Tabea, please share your slides and the floor is yours. You have 15 minutes.
Okay, is it working?
Yeah, make it a presentation, like a slide, yeah, presentation mode. Perfect.
Now? Okay.
Yeah.
Good. First of all, thank you very much for giving me the opportunity to discuss this very interesting paper. When I was first asked, I saw the title and I was like, this is a mix-up. We had the same title a couple of months ago. Actually, we had changed our title in between. So I saw that it is a different, very interesting and related paper, and it's just a great opportunity to give a discussion. Now, let me briefly summarize what the paper is about. So it's an audit study of financial advice taking place in Hong Kong, and the authors are cooperating with a market research firm and trained men and women to act as mock clients and visited financial advice firms in the Hong Kong area. They conducted more than 400 visits to around 102 branch offices across 65 firms. And essentially, they are using 32 so-called avatars. So they have different profiles, as Amit explained very well in his presentation. So they are varying the profiles according to gender, and then they're giving a script with specific sentences that the clients could use to signal high or low risk tolerance, high or low confidence, and domestic and an international outlook. Otherwise, they try to select a very homogeneous group of clients as to make the auditor visits very convincing to the advisors. After each of the visits, the avatars had to fill in an online questionnaire about the recommended products within 24 hours and about all the kinds of details about the advisory meeting. And these mock clients were randomly matched with the advisors that they visited. The main empirical results are that on average, financial advice that is given to these clients is rather low. So almost 40% of all clients receive only recommendations for individual risky securities, and around 40% only receive recommendations for local securities. What they also find is that women are significantly more likely to receive recommendations for buying individual and local securities, but this result only holds for financial planners and not for security firms if they look into them, the results in more detail. Now, they also set up a theoretical model to explain the mechanism, and basically it boils down to the fact that the incentives of financial advisors working for security firms are different from the incentives for advisors working for financial planners, and the interaction of these incentives in combination with the stereotypical beliefs about the financial knowledge of men and women clients drive the behavior of these different advisors. Now, let me come to the comments. So overall, I think it's a very nice paper. I enjoyed reading it. It's a very well executed experiment. It's very clearly written. And overall, I think it's just a very nice paper. So in general, I also think that you're already relating to a lot of the literature. I think you want to be a little bit more nuanced, because a lot of literature is actually coming up on these gender differences at the moment. And so I think you might want to look also into the literature on financial literacy and confidence. I can give you a couple of references there. Then we already mentioned now that there is a literature on gender and financial advice. Actually, interestingly, in some of the earlier papers of financial advice, or the analysis of the quality of financial advice, there were already some gender differences, but they were not the main points of the discussion. But maybe you can just recheck these papers and cite some of the results that they might not explicitly discuss, but that they are on the go, that are there on the go. And then there is some literature that I also came across that is on discrimination in financial markets, so especially on race discrimination in financial markets, but also some papers on gender discrimination. And in particular, what these papers find is that women are very often offered different interest rate on loans compared to men. So that might also be something that you might want to cite. As you already mentioned, and as I already mentioned, we have a very related paper, and I think it's very interesting to see how your results and our results are actually complementary. So what we're doing is we have a set of advisor-client protocols, so from real advisor-client interactions. So it's no experimental data, but real-world administrative data from a large German bank. And what we find in that data is that women on average receive recommendations for less risky products, even if we control for risk preferences. The women pay on average higher management fees on the funds that are recommended to them, and they are less likely to receive rebates on the upfront loan. So on average, what we find in that data set is that women tend to receive more costly advice compared to men. And that is mainly driven by the fact that the women are likely to receive recommendations for the bank's own balanced funds, which carry particularly high product fees. Now, the mechanism that we're suggesting is actually quite similar to the mechanism that you're suggesting. And that is that in the interaction between financial advisors and their clients, the financial advisors try to use the information that they're receiving, but they're also using imprecise signals about the client's financial literacy in order to provide advice to the clients. So clients who appear less financially literate, in our case as well as in your case, women, receive worse advice. And the twist is that if you have a woman with who is signaling low financial literacy but is actually literate, they should be more likely to reject a given piece of advice because they realize that the advice is bad. And so that's why we have the second hypothesis about the rejections. And actually in our data, this is exactly what we find. Now, the problem that we have, or the challenge that we have with our paper, is that we cannot actually really separate the supply effects from the demand effects. So it could be in our setting that women are just asking for different products compared to men. Now, in your setting, and that is what I really like about your paper, is you're essentially fixing the demand side because you're working with the avatars. And so basically you can boil down everything that is happening to the supply side. Now, I think that's essentially how I see the complementarity between our papers. So basically, we can show this matters in the real world, and this has really high cost for the women who are seeking advice. But at the same time, we're still subject to the criticism saying, well, that maybe actually the women want these products. And on your side, you can actually say, yes, but no, this is what we are holding constant, but you are doing it in an artificial or in a more artificial setting than what we are doing. And so I'm just really happy about your paper and how it helps to contribute to find out something about what is happening in financial markets and how different people are treated differently. So I think together they make a really, really great contribution. Now, the comments that when I read your paper that I have is that so essentially you are fixing the signals that the avatars are giving. So what we know from the literature is that on average women seem to be less confident, they are more risk averse, and they are less financially literate. And so if an advisor meets a woman, then this is everything that they might have in their mind when they're advising them. Now, the signals that you assigned to the different avatars, for example, regarding the confidence, is that somebody signaling high confidence says, I usually make the financial decisions myself. And the one signaling high confidence signals, I've never made important financial decisions. You are saying that this signals low confidence and high confidence. Now, I have a little bit of a doubt about this because at the same time, I think this also signals experience with making financial decisions versus no experience. And that might also be correlated with having low financial literacy versus high financial literacy. So to actually attribute this information only to confidence is something that I'm not entirely convinced of. And so maybe you would want to think more about, and that's why I also mentioned the literature on confidence and financial literacy in the beginning, on the difference between the two. And from my perspective, in your setting, you cannot really disentangle the two. The question is whether you need to. I mean, you could also interpret them jointly. But I think this is a point that you should probably discuss in your paper. So the question is, in that context, or the question that I would put down there is, did this signal work in the way you wanted it to work? So was gender used as an additional proxy for risk tolerance and confidence or financial literacy? So what is left? So basically what you're doing in your regressions is you're controlling for gender in addition to the signals, and the signals are risk tolerance, confidence, and this home bias versus not. But and then you're saying what is left is financial literacy. So the gender effect boils down to different expectations about financial literacy. And I'm a little bit worried about the fact whether you can really follow with this interpretation completely. Especially because financial literacy and confidence seem to be very highly correlated in what you can see from other papers. Now, one result that I actually struggled with a little bit, and I haven't still wrapped my head around that completely, so maybe we can also discuss this a little bit more. You find that women who signal high confidence and high risk tolerance are given the worst advice. So these are the women who are actually going against the stereotype, but then receive the worst advice. And so my first question was, were these women playing their roles convincingly? So is there any way that you can check whether the advisors actually really believed the signals that they got from these women? And also, in our paper, what we find is that women are given advice to buy less risky products for a given level of risk tolerance. So in a way, what we find is a little bit at odds with what you find. So in our context, with it, which is not a controlled context, as in your case, but what we find is that even if the women give information about their risk preferences, the stereotypes still to some extent overrule these signals. And in your case, it seems actually to be the opposite. And I'm just wondering why. So the question is, what is more important, the stereotype or the signal, and in which context does which type of information matter more? Now, we actually just recently, and that's not in our paper yet, we're working on that currently, we ran an additional survey among advisors, and we asked them whether they thought which role stereotypes played when giving advice. And what we actually found, and that's just very preliminary evidence, is that advisors seem to think that stereotypes play a greater role in advising women. So, so that's an additional piece of evidence that we're going to write up, but that also seems to be a little bit in conflict with the result that you have there. And I'm just very curious what's going on there. Now, the next two comments are a little bit more technical. So I saw in your paper that you're coding no specific advice. So if an advisor refuses to give a specific advice as undominated advice, I was just wondering whether you could run some robustness checks on that, because as you write in the paper, the motivation for not giving specific advice can be very different. So either they can do that because they just want to inform the client. I'm almost done, so 1 minute is fine. Or because they are required to open an account first, and they are, from my point of view, very different motivations for not giving advice. And so I was actually wondering whether you can separate those motivations for not giving advice more specifically, and whether you could also run a multinomial regression where you explicitly model not giving advice versus dominated advice versus undominated advice. So that could also be an approach. And then the final one is, and maybe you just didn't write it down, but I think you cannot treat the observations as IID because essentially you only have 32 people that visit the advisors, and you only have, I think, these 65 firms. So I think at least you should take account of the by clustering the standard errors, but maybe you would even have to do a little bit more to adjust for this non-IID nature of the observations that you're having. Okay, so thank you very much again. I think this is a really interesting paper, and I was very excited to read it. Thank you.
Thank you, Tabea. If you unshare your slides. So let me see if there are some questions, but I haven't seen any raised hands. So in that case, I'll just give the possibility to Amit to reply briefly, because we are 5 minutes. Oh, there is one question. So There we go. So Alessandro, please take the floor. Shoot.
Hi, very interesting paper. I was just wondering if you can rule out the fact that, advisor might know the women have an income gap, for example. And even if they show up with the same income as men, this might be expected difference in income. And so they might want to make up for it, just suggesting more like riskier options, which would have higher idiosyncratic volatility, for example, individual stocks or home bias. So without knowing anything about the suggestion and the performance, the ex-post performance of the suggestion, is very hard to rule out the fact that they are trying to make up for this, for example, income gap by suggesting riskier portfolios.
Perfect. And now Anders has a question. Anders, wait a second. You can talk, but we can't hear you.
Now, you hear me now?
Yeah.
Oh, sorry. Yeah, I was just curious about, you were talking about overconfidence, and there was a claim here that overconfidence was correlated with knowledge, but I guess it depends a little bit how you think about overconfidence. So it's a confounded concept. I think you can think about it as the precision measure, and then I agree that people who know more tend to be more precise. But you can also think about overestimation, sort of how much you think you know. And then I think the work I have done with David Robinson suggests that this is more prevalent for people who actually know less. So I guess it would be important how you think about overconfidence when you talk about it. I just wanted to have your view on that.
Okay. So please quickly, let's hear your reaction, Amit.
Yeah, sure. So first, thank you, Tabea, for a wonderful discussion. So that was really great. So, okay, so next we move to some of the questions. So one of the most important questions that Tabea raised is obviously that, did the signal work? So we have certain, what we can observe is that first, that we trained all the auditors exactly the same way. And then second, that the advisors are responding in the way in which the signals they are expected to be responding. So it seems to be the case that the signal is working. So all of the auditors delivered the exact same dialogue when they said that I can afford to take some risk, I can afford to lose some money, can you help me with the advice? So we try to control for that fact that the signal should be standardized and it is delivered to the advisors. Now, the second very important question was that was the correlation between the confidence and the financial knowledge. So here, what we did is in our hiring procedure, we standardized that we are not going to hire a very knowledgeable auditors. So we made sure that, at least from the education perspective, all of them have a very limited financial experience, and none of them have a bachelor degree in any of the STEM programs. So all of them are like, in fact, except one, all of our auditors were less than undergraduate. So we wanted to ensure exactly this fact that they should not have a wide variation in terms of their knowledge or literacy. So, and the third question that came from the participant, Andreas, which was that, can they be responding to the income gap? So here in this script, what we did standardize is the investment objective. So we said to each of our auditors that all of them are going to say exactly the same amount of money. And they're going to say that I want to invest about 100,000 of Hong Kong dollars that I have in my saving, and I want to save it for the retirement. So we fixed, since their age is kind of standard in the small bracket, and we fix this amount that the auditors explain to the advisors that we have available. So we try to take care of the fact that there might be the income gap as well. And finally, yeah, there can be a correlation between financial knowledge and overconfidence. Yeah, that's true. So I think that is my response. And once again, I really want to thank Tabea for the wonderful discussion.
Okay, so let us move to the next paper.